Let me turn my camera on.
All right. And I'm going to start to say hello to everybody. My camera's on too. Hi, guys. I hope you're doing well. I want to welcome you to, and I can see you, Steve.
Okay,
good. Let's go ahead and let's do this before I forget. I'm going to go ahead and kind of switch over here to this. Today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. We also will be talking very specifically about symbols that we may or may not like, things that we may or may not own, and we are not really giving advice. We don't know what your situation is, how much capital you have. Everything that we're going to be doing is for entertainment and for educational value. So keep that in mind as we go through. And Steve, do you have anything to add to my beautiful legal disclaimer?
Can't think of anything other than we got a much more accurate read on price movements based upon the signals and the patterns. So we could start with that. You've got the Dow chart up.
Yep.
And
we do. Let's kind of talk a little bit about it. We had a bit of a pullback today.
Yeah, but that pullback was expected. So at the bottom of your chart, you've got stochastics, which are up in the overbought area, which tells us, obviously, we're overbought. Yesterday, we had what you call a shooting star harami. The shooting star looks like a shooting star. It's a small body with the shadow, big shadow to the upside. Shooting star, there's only one formula that you have to know in candlestick analysis, and that's the number 2. But the tail is 2 times greater than the body on a shooting star. And there's other signals that use that same formula. But that harami, which means it opened and closed inside the previous day's trading, tells you logically that, or the Japanese rice traders say the buying has stopped. The fact that it did a shooting star told us more than likely, if it opens lower today, which it did, it's at least coming back to the T line, which it did. So we were pretty prepared to expect profit taking to occur once it opened lower today. So that's where you can observe the obvious. If you go back to February 1st, right in that area.
Right here.
Yes, so there's that bullish harami, which is a doji harami inside the previous day's trading in the oversold area, right at the 50-day moving average. That pretty much told us if they opened positive the next day, the selling had stopped and the buying had started. In this case, it gapped up, which told us not only did they tell us the selling had stopped, but the new force of the buying had started. So going back to yesterday, that shooting star harami was a good indication that the selling may be starting. Now, if you want to flip over to the NASDAQ chart.
Now, I'm gonna, before we do that, I'm just gonna say if I know you well, you're gonna be looking at where this opens in relationship to the T line on Monday. Would that be a pretty safe assumption?
Yes. So now with your stochastic starting to head lower, your shooting star signal followed by a gap down. Remember, shooting star, that tells you there's a possible reversal. The gap down told you not only were they selling, but they were selling with great force. That usually implies there's going to be more downside.
Okay.
So now if you go to the, so you don't have to analyze a candlestick chart index on its own. You can see what happened on the NASDAQ yesterday. That's what we call a kicker signal, because the previous day, that bullish candle was followed by yesterday, where it gapped down at the previous day's open and went the opposite direction, meaning down. number one, that's one of your strongest reversal signals. The investor sentiment has been kicked in the other direction. Now, you also add up the fact that when they did it right at the 50-day moving average where they were selling off hard. And not only did they sell off hard with a kicker signal, but it closed below the T-line. Now, for people that are watching tonight that don't know what the T-line is the 8 exponential moving average. And it acts like a Fibonacci characteristic. So the most powerful statement that I make about candlestick analysis is, if the candlestick signals are the graphic depiction of investor sentiment, everybody buying and selling, and the T-line acts like a natural support and resistance level of human nature, when you combine those two, you've got an extremely high probability trading platform, not only seeing what the investor sentiment is, but what the probabilities are. And the probabilities are that when you close below the T-line, you can stay short until you see a candlestick buy signal and a close above the T-line. If you see a candlestick buy signal and a close above the T-line, you can assume you're in an uptrend until you see a candlestick sell signal and a close back below the T-line. So in the case of today, where we saw the positive trading on the NASDAQ, that shouldn't fool people into thinking it's turned around, because you're still trading below the T-line after a strong sell signal, and it couldn't even get back up to the T-line. That the assumption has to be that we're still in a downtrend until we see a strong buy signal. So that's the market direction right now. I think we're selling off. Now, that doesn't bother us, because on very simple scanning techniques like Apple, you can see on Apple that when it closed back below the T-line yesterday, they tried to take it up today, but took it down because the probabilities are, like you saw back over on January 20th or so.
Right.
Now, further right, up there at the top.
Right here. Okay.
January 20th. Did I say the wrong one?
No, you said the 20th. I'm just trying to find where that is. It's right here.
Okay. No, go even further right, up there at the top.
Right here. Okay.
Yep. And now when they gapped it down the next day, closed below the T-line, when anything closes below the T-line, it tells us the probabilities are pretty strong that the downtrend has started. So anyways, that's, and I tell people, don't take my word for it. Throw the 8 exponential moving average on your chart and see how often it occurs that prices will even come up right smack dab to the T-line and then fail. And the reason that is relevant is nobody has the T-line on their chart. Everybody can see what's happening at the 50-day moving average or the 200-day moving average, because everybody has that on their charts. The fact that you see quite often where it fails right at the T-line or supports right at the T-line is relevant, because nobody has that on their chart. That just adds that much more credibility. But that's where investor sentiment turns, and we just use the 8 exponential moving average to indicate that's the support or resistance level. Oh, I forgot to mention to Kelly, if anybody has any questions, tell them to feel free to ask questions, and we'll try to answer them as we go along.
And if you have symbols you'd like us to look at, go ahead and let them know as well. So in any case, is there, I'd like you to look at a stock. I want to get your opinion on this one. Now, in all fairness, I do own this one. So let's go ahead and, do you mind looking at car.o?
Oh, KAR. So my assumption on this one would be you stay long until the probabilities go against you, and the probabilities are this one hasn't closed below the T-line.
Nope.
So all you have to do is stay long on this one. Now, what could be setting up is what we would call the J-hook pattern, one of the patterns that we can scan for. that if this opened positive and started trading positive on Monday, now you've got what we call a J-hook pattern. You can see the prerequisite, which was the uptrend starting from little late February. Now it's pulled back, and this is where the relevancy of the T-line becomes extremely effective, because notice where it pulled back to.
Right to the T-line.
To the T-line. And now if it starts trading positive from here, we can see that it's doing a J-hook pattern, meaning we've already gone through wave 1. Wave 2 is this little pullback. And if it starts positive from here, wave 3 should be about the same equivalent as wave 1.
Okay. Yeah. I've been waiting for an excuse to, but it just won't shut. It won't close down below the T-line.
Right.
And you can see how well this works, because like it just keeps finding support right here at this T-line. So, so there you go. Is there any stocks that you in particular want to look at, Steve?
We have been touting the electric vehicle sector. Now it's been drifting. So if you want to look at QS, that's QuantumScape. So we've got a new system that we use, especially with the scanning technique. QuantumScape if you went way back further, this one just skyrocketed. And now it's basing. But QuantumScape, this is where I tell people you don't need to know very much fundamentals, because the fundamental analysis of everybody buying and selling is already built into the chart. However, QuantumScape is developing a battery that is not liquid-filled lithium. It's a solid-state battery, which has tremendous capabilities over and above the liquid. So they haven't produced it, but they're the closest one to having a solid-state battery for automobiles. And so that one you can see has started up, and it pulled back over the last few days right to the T-line. But if it starts trading positive, you've got a J-hook pattern. Now, because we can see the direction of a price move based upon where it supports and resists, now we use the T-line, which is something that nobody else uses because they just don't know about it. But we can see where it failed about a month ago, right there at the 50. But we use everything else to project targets. And right there, you can see there's a gap. You were on it. If you go back right there, there's a gap right there, which means that makes for the next logical target. So if you kind of go from where it bottomed out, right? Yep, you were right there. And we did a wave 1. No, further right.
Right here? This wave?
No, further, your other right.
Oh, my other right. Yeah, they covered this in the military.
That's
here?
Right. No, further right,
right
at the last little bottom. Okay, right there. Now you can see you had a wave 1. Then it does the J-hook. If it goes into wave 3, the approximate wave 3 should be up to where it fills the gap. So at least we have a target based upon we know if it's moving in that direction, what our next target should be. Now, that also helps if you're a stock trader, obviously. If you're an option trader, you've got a lot more flexibility as far as the different strategies you can put on, like not only buying the calls, but maybe buying spreads that are very inexpensive, much higher, that if this trend works like it should, those inexpensive spreads can produce mega profits. So it just gives you a lot more insight as to where a target could be based upon the pattern that's developing.
All right. And then Nyan wanted to know, what are the other MAs are you using other than the T-line? So
the ones I have on my charts are the 50-day moving average. That's the blue line you have on there.
Right here. Yep.
Yep. And then we put the 200-day moving average on. And the reason those two are on the charts is because that's what every major money manager around the world uses as their indicator to make their decisions about their portfolio. So a lot of people say, well, why don't you use the exponential 50 and the exponential 200 versus the simple? Is because we're not using those to make our decisions. We're using those to see what everybody else's decisions are at those levels. So because the graphics, the candlestick tell you what's going on between the buyers and the sellers, we're seeing where they're buying and where they're selling. So those are the two basic ones. Now I also add the 34 EMA, which I call a secondary moving average. And it works reasonably well enough that you want to have it on where I put it on my chart. So, but I could take everything off this chart except the candlestick signals and the T-line and trade extremely successfully. So as long as you don't have your chart cluttered up, you can put whatever you want to on it. That's the nice thing about candlestick analysis is the top priority or the top indicator is the signals themselves. Everything else after that becomes a confirming indicator. So very simply, if somebody says, put the XYZ indicator on your chart, see if it works. Well, if you put it on there, knowing that the signals are the ones that are the top priority, if that new indicator enhances the probabilities or lets you see more clearly what a trend's going to do, keep it there. If it doesn't, take it back off. So I could use the stochastics, the T-line, and the stochastics. I use 12-3-3 because I'm a swing trader. Mm-hmm. And so one night I just sat and kind of tweaked the charts and said, all right, where is there a peak and what's the best numbers to tell me that peak's going on? We started with 14.55, so we went to 14.53, 12.55, did all sorts of numbers, and 12.33 has worked very successfully. Now I forgot the question. So those are
the indicators. I think we should talk a little bit about how you use the 3 EMA because I find that's quite helpful too. So
the 3 EMA works effectively. The further away, let's say, so the T-line rule is if you see a candlestick buy signal and a close above the T-line, you can stay long as you don't see a candlestick sell signal and a close back below the T-line. With the caveat that the further away you move from the T-line, the higher the probability it's going to come back and test it. So that tells you that if you start seeing the most simple analysis that the Japanese rice traders have produced for us was where do most people buy? They buy exuberantly at the top. How do we tell that the exuberance is coming into a trade? Because we can see the candles get much bigger and you're starting to move way up above the T-line. That takes you to another strategy, that when you see something trading way above the T-line, flip to your 10-minute chart. And then as long as your 10-minute chart stays above the 10-minute T-line, you're all right. But as soon as you see a sell signal and a close back below the 10-minute T-line, you start taking profits because you're using that faster indicator because you already know the daily chart is way too far away from the T-line. More than likely, that's where the selling is starting, and it's going to come back and test the T-line.
All right.
Oh, so the 3 T-line works effectively that the further away you are from the T-line, the more relevant the 3 T-line becomes.
Thank you, Steve. Ron wants to know if we can look at XPEV.
Yep, that's still in an uptrend. And as you can see with the Dow pulling, or the NASDAQ pulling back, if you go back to the very bottom, no, to the right, in this last little uptrend.
This one here?
No, the other right. Way
this
to
one?
the, yeah, mine looking at the right. There you go.
Okay.
You see how after that last dark candle at the very bottom,
mm-hmm.
they gapped it up above the previous day's open. That told you there was a lot of buying come on. Doesn't look very strong because it's a doji. But then they started trading positive from there. And so now your basic rule is as long as you're above the T-line, you can stay long. Now, would you be buying here? You could, but then your basic rule is you just keep your stop just below the T line because it shouldn't come back down through that level. What's the next likely target? Probably the 50-day moving average. But the reason it becomes less attractive as a buy because your stochastics are already up in the overbought area. So candlestick logic is you want to buy when you're in the oversold area and you see a buy signal. Even though this is still in an uptrend, if you're buying now because you think it's going to go higher, you just make sure you have a safety stop just below the T line. So a lot of people in our chat room were asking that today, what should they do? And I said, stay long. If you're buying, do that same technique. Just stay long as it doesn't close below the T line. Now look back at the back in late November, the peak.
Right here.
Yep. So what was the warning to take profits up there? Because we still hadn't had a sell signal that was confirming. Because look how far away you are from the T line. And now you're seeing a doji, a potential reversal signal. That would have told you on that day you would probably at least have closed half the position. And then if it went higher, all right, you're still making money, but you're in an extremely high risk area. If it opened lower the next day, the doji rule is the price is usually going to move in the direction of how they open after a doji. And the fact that they opened it lower, that far away from the T line after a potential reversal signal, just logically said that's time to take profit. So if you sold half up there the previous day and sold half there, at least you can go to sleep at night saying, I got most of that trade profit in my pocket. Now it looks like it's going to be selling off.
I like the way that you explain this, Steve, particularly when you're talking about doji as being kind of like indecision. So you've got your indecision here. Your gap down, they've made a decision, right? So
exactly, yes. And so that's what the Japanese rice traders, that's the whole point of studying candlestick analysis, is because this isn't hypothetical stuff. This is from the Japanese rice traders investigating or studying and utilizing the signals that are created over the last 300 or 400 years. So, and I always mention that the Japanese rice traders didn't become wealthy trading off of candlesticks. They became legendarily wealthy. They were the financial powerhouse in Japan for centuries. And it was all based on one simple factor. Human nature works the same way time after time. And they became legendarily wealthy on the most boringest commodity in the world, rice. That doesn't move around very much. So candlestick analysis can be used for any trading entity that has fear and greed, which is all trading entities.
Let's take a look at OSTK.O for Nyan.
Yeah, overstock.
There you go. Overstock.com, yes.
So you saw down there, look at your doji, down in the oversold area. Now you had a bullish candle right after that, and it closed right on the T line. The next day it opened positive, but here's what we teach in the entry strategies. We wouldn't have been buying on that day because as soon as it opened that day above the T line, where was it going? It immediately started selling off, and that would have been evident in the fact that that candle was turning dark or producing a dark candle. Now, the next day when it gapped back up and started trading positive, that's where we would have been buying. Why? Because it wasn't closing below the T line, and we had buy signals 3 or 4 days before that telling us there was a reversal. Now, how long do you hold on to this one? As
Let me
long
guess.
as it stays, as long as it stays above the T line.
I was going to guess that.
Okay. So now you have a much more visual analysis. Today it closed right on the 50. It bottomed right on the T line. You're in the overbought area. So what do you have to visually conclude? Maybe it's resisting at the 50. We don't know that for a fact. So what would be our trading strategy? Well, if it started trading lower, we probably want to take profits because that means they're not going through the 50. And definitely we would have our safety stop at the T line, because if it came down through there, that was pretty convincing evidence that they weren't going to go up through the 50.
Okay, thank you. That was good, Steve. Let's look at Yum. This one's for Ron.
Another simple trading rule. You saw how strong this chart was the previous three candles prior to that dark candle. We got a very simple rule. Notice that your stochastics were in the overbought area. The last place a bullish trade should be trading is at the open of that last bullish candle. Because logic says, look how far away you've moved from the T line. You're in the overbought area. If the sellers have enough strength to bring it back down through the open of that last big candle, the sellers are back in control. That's where your safety stop is in place. The probabilities tell you if they can come down through there, they're selling off. Where are they selling off to? Maybe just back to the T line, but you don't know if it's just back to the T line. It might be back to the 50. So the worst case scenario is it comes back to the T line and you see buying, you can always buy back in.
So you'd put a stop on this one if you're in it right below the open here. Did I hear that right?
Yep. So when it was trading positive that next day, during the day, I would have probably moved my stop up to the open, because even at that point, that if it was trading up there and it had enough selling pressure to take it back down through the open, it was telling me I was doing a shooting star signal. And where was that shooting star signal occurring? Well, if you follow that line right back to the left, it was right at the same areas they were selling before. That was pretty much telling me in the overbought area of the shooting star, that's where I wanted to close out. The fact that the next day they opened it and traded it down, it would have hit my stop at the open of that day, and I was out of that trade.
All right, let's take a look. This one's for full 8. We're going to look at CTRM. Castor Maritime. I don't think I've looked at this one before. It's a new one for me, Steve.
All right, so that one I would call a nothing chart.
You'd say next.
Huh? I would say next. Which way is this going? You don't have any buy signals that are being confirmed. You're trading right at the T line, and you have absolutely no direction on this one. Now, here's an important factor, too, about human nature. Look at that last price move a month and a half ago, where it skyrocketed. And then notice when you were too far away, or that moved that far away from the T line on that last big up day, if you were up at the top of that trading range, that would have been your alert to say, look how far away I am from the T line. I better go to my 10-minute chart. Now, if I held on to it and they gapped it down below the low of that previous candle, you would have been selling it immediately, because back to that same simple logic. If you're in an uptrend, they shouldn't have enough selling pressure to gap down below the previous day's open. And when it did that, where do you think it was likely moving to? Back to the T line. Now, after that, notice what it's kind of done from that point. Not really anything. Kind of moves sideways. That's the normal tendency after a big spike up move, that as soon as you hit the level where the bulls and the bears are in control, they usually go flat for quite a few months, or let's say a month or two. So that's the normal tendency. After a big price move, price will go pretty much flat. Pull up TLRY.
Okay. Here it comes.
Okay, there's your perfect example. Up there was your hanging man signal, that far away from the T line. That's where you would have been taking profits. Then notice the next day they sold it off. That told you the bears now were fighting the bulls, and after that, it's just kind of gone dead. So I used to be thinking, oh man, that had a big move. Now it's pulled back. I'm going to get ready for the next big move. And I'd buy, and nothing happened. I eventually learned that once you had a big move like that and you found where the bulls and the bears were in control, they fought each other for quite a few weeks until you saw the next major bullish signal. And we could point out a bunch of those, but
let's see. Let's take a look at Open. This one is for Jazz Sushi. Here we go.
That's what I would call kind of a junky chart. There's really no direction on this chart. So if you had been buying it on the basis that it came up through the T line, you see it's having a little bit of trouble here at the 50. And you could draw a line down through the recent tops. There's a resistance level. So if you're long, it has to get up through the 50 and through that downtrend to really pay attention to it. So even though it's had a bounce, you can see what the overall trend of this stock has been. Just kind of junky sideways. So the only trading strategy you have at this point is you better see it get up through the 50. Otherwise, there's probably much better places to have your trading funds. And that's the one question, rhetorical question I tell people when they ask about a chart that doesn't look great. I always say, if you were looking at this chart, ask yourself, is this the best place to have my money? And if it's not, remember, there's 9,500 trading entities out there. On any given day, using the scanning techniques, you're going to find 5, 10, 15, 20 good trade setups. Now, that's way too many for most people, but because of the information built into the charts, you can cultivate those good trades to find out which ones are the best trades, by which ones have the strongest signals, which ones are bouncing off of levels that everybody else is watching, which ones have broken through the T line. So very simple logic. If you see a candlestick buy signal and a reversal and it closes above the T line, that's just added information that there's been a reversal. You're probably in an uptrend.
All right. Let's see. Big Chorney says JMIA.
Jabaya is still in a downtrend.
Okay.
So you can see the dark cloud that occurred right at the 50-day moving average. Then you just up above that dark candle opened positive in the overbought area and then closed more than halfway down the previous candle. That's your dark cloud, one of the 12 major signals. Now, when I say one of the 12 major signals, there's approximately 50 or 60 candlestick signals. And when I was first learning candlesticks 30 some odd years ago, I wanted to learn every single one of them because I was a greedy son of a gun and I wanted to know every good buy signal. But as I would go back through the charts and analyze which ones had reversals at the tops and the bottoms, I discovered there's only 12 that you really need to learn. So I tell people you don't need to spend mental time and energy trying to learn all of them because some of them you'll hardly ever see. So why spend time? So I tell people, at least when I've got 3 books out on candlestick analysis. I tell people go back through and just occasionally browse all the 50 or 60, but the 12 major signals are what you want to learn. So the dark cloud is one of those 12 major signals. And look where it occurred, with your stochastics up in the overbought area and telling you that you failed at the 50. Now, this is what we call a blue ice failure. If you had the 200 on your chart, you can see that wave 1 came down.
I'm going to throw it on here. 200. Okay. Here it comes.
All right. So this is what we call a blue ice failure. So if you go right up above that, at that little bottom.
Right here?
All right. Yep. Notice there isn't a signal there. That's not a signal. That's just an up day. But this is what we call a blue ice failure. Notice when it came down through the 50, about a week or 2 weeks before that, it failed at the failure. And my late friend Dave Elliott of Wall Street Teachers defined that as somebody falling through the ice. So they flounder around, they come back up to see whether they can find the hole that they fell through. They can't, so they drown. So their next target is the bottom of the pond, which is the 200-day moving average. Now, poor David, when we would go around the country showing people how to do trading using the signals, I would always help people remember the blue ice failure, because I'd tell people, say, how do you catch a polar bear? You cut a big hole in the ice, and then you take a can of peas and you spread it around the hole. And when the polar bear comes down to take a pea, you kick him in the ice hole. I tell people that wasn't a very technical description, but they remembered the blue ice failure. But so there's your next target, is if this opens lower on Monday, you're probably confirming that you're heading for the 200-day moving average. So now, if it opens lower on Monday, it's also doing a signal, which we call the doji sandwich. You had a big candle yesterday, and you have a doji today. If it opens lower, the doji rule, it's going to trade in the direction how they open after a doji. If it opens lower, more than likely it's going to do a candle the same magnitude as the candle before the doji, which means there's going to be more downside with the doji sandwiched in between. It's just a very high probability trade setup that if you have a doji sandwich, your expectation is you're probably heading even further down. And it works just as well on the bullish side, that you could see a doji sandwich to the upside, that if it opened positive after a big candle and then a doji, if it opened positive after that doji, more than likely that next candle is going to be the same magnitude as the candle before the doji. So that's called a blue ice failure. I would stay short on this. I wouldn't be long. Number one, because yesterday it closed below the T line. Number two, you can see it failed at the 50. And number three, if it trades lower, it's probably going down to at least the 200-day moving average.
All right. Nyan has a pretty good question. He says, thank you, Steve, is what he says. By the way, do you place stops at the T line if you're long?
Only if you're hugging the T line. And remember, there's two important facets of a candlestick signal: where it opens and where it closes. So there's sometimes where if you're hugging along the T line and it trades below the T line, you still have to wait to see where it closes that day.
And you specifically want to close below the T line.
Exactly. If you go back to the Dow chart.
Okay.
You can see it kind of closed right on the T line. Now, this is probably a bad chart to illustrate that. But earlier in the day, 20 minutes before the market closed, the Dow was only off 95 points. So it was trading up above the T line. So the fact that it came back down and closed right at the T line gave me a completely different perspective, which was it was confirming the sell signal of yesterday. And if it opens lower on Monday, it tells us we're still in a downtrend until we see the next buy signal, which could be all the way back down to the 50-day moving average, which tells us the probabilities right now is that we want to be scanning for short positions versus long positions.
All right. Let's take a look at KNSA for big again. And Nyan, or full 8 seconds, says, thank you. You have a new subscriber. To subscribe, go ahead and make sure you subscribe to the YouTube channel. But if you want to subscribe to the Candlestick Forum room, would you go to StephenBigalow.com?
StephenBigalow.com or www.candlestickforum.com.
Okay, and I'd recommend it.
So this is where we use, and for those of you that want simple scanning techniques, I hope you're here because Metastock is probably one of the best scanning softwares that you're going to come across. And I'll do the plug for you, Jeff. Jeff and I have been working together for years, putting all our
decades,
signals
I
and
think,
patterns,
now.
on Metastock. So not only do you have the charts to scan, but you can also apply which signals will show up, or you can set up your charts to where when you look at a chart, you can see what signals have developed. On this one, there's another rule.
Bearish engulfing question mark, and I think that's a huge bearish engulfing.
It is a huge bearish engulfing. So here's the things that I would look at. If you kind of drew a line right across the tops here,
tell me where you want it.
Yeah, it's anywhere right in there. You can tell that that's kind of a resistance area. And then today, with that big selling, another simple trading rule of candlestick analysis is the Japanese race traders always tell us the bigger the signal, the more compelling there's a change of investor sentiment. I would be shorting this one on weakness on Monday. My first watch would be to see what it does at the 200. And if it breaks the 200, obviously you're still in a strong downtrend.
That's a huge candle. That's a big one. Let's go ahead. Nyan wants to know if we'll look at HD for him. Willing to do that?
Yep.
Okay, here we go.
All you can do here is stay long. Now, here's what I would do if I was long. Look at the bottom there about a month ago.
Right here?
Yes. There was your bullish Harami hammer signal. The hammer was the one with the bottom one with the white head. Look at the tail 2 times greater than the body. In the oversold area. And what do we look for on a hammer signal? Bullish confirmation the next day, which it did. So if you bought on that day, that would have been aggressive. But look where it closed, right on the T line. If it opened positive the next day, what was your trading strategy? You were obviously buying because what was it doing? First of all, it was confirming the buy signal, number one, which was that bullish Harami kind of morning star signal. And number two was telling you the T-line was not acting as resistance anymore. So you had a candlestick reversal signal confirming by closing or trading confirming the signal itself and telling you the T-line's not acting as resistance. You could go long. And then how long do you stay long? Until you see a sell signal and a close below the T-line. With the caveat, again, if you're starting to move too far away from the T-line, where would my safety stop? Anytime I'm in the overbought condition and I was holding on to that, on Monday I'd have my safety stop at the open of today because logic says if the sellers have enough strength to bring it back down through that level, that's probably where you want to start taking profits.
Oops, I missed the open, but I think the idea was got it. Okay. Jeff says, thanks, y'all. Let's go ahead and look at CLVS. This is for Paramount.
Clovis broke out today because they announced they have a cancer treatment. This is what we call rare research. You saw the big move. Now, before I told people you don't have to check what the fundamentals are because that's already built into the candlestick signals. However, there's enough strong sectors like the biotechs and the electric vehicle sector that you want to see who's coming out with the strongest or the newest innovations. Well, Clovis, as you can see, did a little kicker type signal. Again, a kicker type signal is yesterday it did a dark candle. Today it gapped up above the previous day's open. Now, the reason I say kicker type signal Usually you want to see the dark candle be a substantial candle and the white candle being a substantial candle. Well, the fact that that wasn't a great substantial dark candle, it's still a kicker type signal. They gapped it up and traded positive. Now, when would you have been buying this one today? That's where you flip to your 10-minute chart to see if it's still trading above the T line. So what does this tell us about human nature? They really like this because the announcement that they had been approved for their system for treating, I think, ovarian cancer without having to do chemotherapy was approved, I think, by the FDA. And so that told you. Now, this is a good example of wanting to see what the investor sentiment tells you it's doing. And in this case, it's favorable. If you'll pull up WPRT, this is a perfect example of why you let the charts tell you what the investor sentiment was. Because 1, 2, 3 days ago, that big dark candle, look where it opened. It opened positive because they came out with fantastic earnings. Logically, that should tell us people should be buying this. For some reason, they weren't. So when it opened up positive and we're ready to buy, as soon as it starts trading lower, it tells us, wait a minute, let's not buy yet. And in this case, it never told us to buy because as soon as they opened it, the sellers were in control. Now, where would I have bought that on that day? Well, if they opened it positive and started trading it back, then turned around and came back up through the open, that would have been a good entry because that essentially would have told you the profit taking's over. It's time to buy. So that was just to illustrate that you want to see what investor sentiment thinks about that announcement. If you will flip to EYES.
All right, there you go.
You can see about 2 weeks ago, you had the exact same signal. That was kind of that kicker type signal. And so then you can see what happened the next day. They announced that they were approved by the FDA for having some equipment that helped blind people see again. It was approved by the FDA. So we were buying on that day. As a matter of fact, the kicker signal became apparent at $2.90, which is just slightly above, right about in there, yes. And we got out at, yeah, because right there, you could see there was a kicker signal being formed. Now, do you chase it? That's where you flip to your 10-minute chart. And as long as the 10-minute chart is still trading above the T line, you can be buying it because it tells you they're still buying that kicker signal. Did we have any idea that it was going to go to $9 that day as a high? Definitely not. So we have hit situations just using simple candlestick charts that tell you when there's a breakout, we can see whether that breakout is going to persist or whether that was just a flash in the pan. We got out at 1775 on that big dark candle at the top because when it was trading up there, very simple rule, look where it opened at the top of that dark candle and then traded positive. But what was our alert? Look how far away you are from the T line. So where would you put your stop if it opened and traded positive? You simply put your stop at where it opened because logic says if they come back down through there that far away from the T line, they're coming back to test the T line. Now, they did come back and test the T line about a week ago. We were buying again. And how long do we hold this? As long as this stays above the T line. So, does every single signal and candlestick analysis work? Definitely not. But it consistently puts you in situations where the probabilities of being an uptrend are extremely strong and putting you in situations where you have big price move potential is extremely strong. If you will go to a chart OCGN, Oh boy. Can you go back, make it small enough to go all the way back to December?
Sure. Is this what you're kind of looking for right here
Right
in this
there.
area?
Yep,
Okay.
right there. That first big, there it is, the first big candle. This is how you detect a breakout. That stock had been trading at 15 cents for months. Then all of a sudden, our scans picked up that it was a breakout. And when we looked at it, it was at 73 cents. So what did we do? 2 steps. One, we went back to see what the news was that caused that breakout, to see if it was just somebody upgrading it, which isn't usually very powerful, or if they came up with something new. They've been approved for vaccines in India, which meant they could also be approved for the vaccine for COVID over here. So we started buying it. The next day it was at $2.30, so that essentially tripled. Now, if you go back to the right again,
Okay.
you can see back at the beginning of February, it broke out again. That time it went from like 580 to, or it may have been even lower than that, maybe $3, and it went up to, I forget what it was, some big number.
Looks like the high was like 19. The open was 9.
All right, and the high was
19.
Yep. So that was another situation where when you were that big a move, anyway, a stock that goes from $3 to 19 in 4 days, and you're that far away from the T line, what do you think is going to happen? People are going to start taking profits. So that's where you flip to your 10-minute chart. And so these are situations where you might only catch one of these every few months, but if you can buy stocks at 76 cents or $3 and get out at 19 or 18, it doesn't take a whole lot of those to have a very good portfolio return each year.
You have go ahead.
Go ahead.
I was going to say you have some feedback on the presentation. Big wants you to know that your strategy makes sense. I see the logic in your candlesticks method, and he's also going to subscribe to your site. So,
all right.
And you can do that.
Here's a simple statement. Here's a simple statement to what he just said. Everything in candlestick analysis is just common sense put into a graphic depiction. When I was learning candlesticks, I'd been a stockbroker for 8 years. I got out of the business because I realized that brokerage firms had no more idea about what moves stocks up or down than the man on the moon. I got out of the business. Somebody threw candlesticks on my desk a few years later and said, "You were a stockbroker. What do you think of this?" It took me 3 months of them badgering me to look at candlesticks because I figured anything as sophisticated sounding as candlesticks wasn't worth the time and effort to look at. But they badgered me enough that I finally looked at it, and the thing that kept whacking me in the side of the head was, this makes sense. And the more I studied it, the more sense it made. So the one thing that I tell people is when you're looking at candlestick analysis, it's just common sense put into a graphic depiction. Everything you learn in candlesticks, you're going to kind of sit there and say, yeah, I knew that. I just didn't see it in a visual aspect like this.
Mike says, good move, Big. I'm a member too. I'll see you in the trading room. And
Okay.
Ralph says, hi, Steve. I love your work. So,
okay.
And I do too. I think I've had a very good opportunity to travel the country, maybe the world with you, and I think it's only improved my trading. Mike wants to, or not Mike. Somebody wanted to look at Costco. Murley wanted to look at Costco.
Costco, Now you had a bottom action about 2 weeks ago where you had the bullish harami. The next day it opened positive and then started trading positive from there. That's a bullish harami, which told you the selling has stopped. Now you've got an uptrend, but you can see today it was an up day, but it wasn't a reversal signal. So the assumption is yeah, you could probably be moving up from here, but you're probably not having the same probabilities, the same magnitude of movement from here. So I would put this in the category of there's probably better places to have your money. Now,
Okay.
if you want to go long on Costco, you buy it on positive trading from here and just don't let it close back below the T line. Because from here, if it opened positive and closed back below the T line, what can you see as far as the price trajectory? It's pretty just sideways right now.
All right. Let's jump to WMT, which is another one from, this is from Merle.
Walmart.
Mm-hmm.
Walmart, I just have a hard time ever trading this one because it's your quintessential institutional trader. It's not going to move around very much. And that's kind of got the same scenario as Costco. You're in a downtrend. You don't have any strong reversal signal right now. You're trading right at the T line. You're in the overbought area with your stochastics starting to head down. I would say move someplace where you have much better probabilities.
Ralph says, I love your work. I watch your lessons every day. Could you please look at BHC? It has a multiple year consolidation. So I'm going to go ahead and pull up the chart.
Let's see, Botch and Loam.
Mm-hmm.
This is the advantage of candlestick graphics. Look what's happening up here. Look at all the dark candles in between the white candles. What's that kind of telling you? The bulls and the bears are fighting in here. Your stochastics are heading down. You've got if you go back about 6 days, that first big dark candle.
This one?
Next two
this
over.
One?
Yeah,
okay.
There's a bearish engulfing signal. It didn't confirm the next day. Then 2 days to the right, you had a bearish harami. It didn't confirm the next day. 2 days to the right, you had a dark cloud. Now it traded back below the T line. If I was long on this, I'd probably have closed it out by now. And again, your probabilities aren't great because you're trading below the T line, and you can see that the sellers are starting to take control because you can see the number of dark candles showing up. Now, if you go back to the beginning of February,
right here,
yeah, you can see that the bulls were in control. Now, here's a very simple logic analysis. Where do most people buy? They buy exuberantly at the top. So one things that we do when we train people to use candlesticks is if you see them gap up in the overbought condition, you want to start looking to take profits because that's where the exuberant buying has come in. As you can see from there, it's going to move relatively flat. When I say train people, this isn't a plug, but we are going to be doing a full comprehensive 2-day training on candlesticks on March 27th and March 28th. That's where we go through the 12 major signals, all the indicators that make it work, the high profit patterns, the top rank signals and patterns, which is the combination of signals and patterns, your entry strategies, your exit strategies, when to take profits, and your scanning techniques. So we go from A to Z, and it's basically changes your perspective on investing, which is prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. And that's what the graphics of candlesticks tell us is what's going on in investor sentiment. Which one is this?
Ralph wanted to know if you had a different opinion looking at the weekly chart of so it's still Bosch Health.
Depends on what your time frame is. And yes, probably if the daily chart is starting to show weakness, and you've seen a doji last week, and you're seeing a doji this week in the overbought area, it's probably starting to look a little bit toppy. So I would, and if that's the weekly chart, it doesn't really have a great, relevancy to me. If your daily chart, depending on whether you're a swing trader or a long-term holder, if you're a long-term holder, yes, you can hold on to it. but expect it to pull back to the T line. So you're going to give up some profitability. But that's the whole point of candlestick analysis is if it's going to pull back and you want to hold on to it, now maybe you go into a different strategy. You might sell some calls against it while you're still holding on to it.
I love all the positive comments you're getting here. Ralph says, thanks, Steve, for taking questions. Yeah, that's a good question. I don't know. Steve?
I guess the best way to do it is if they can go email Abraham at candlestickforum.com, he can get the link to him.
Okay.
Abraham. Yeah, Abraham at candlestickforum, forum.com. He can get the link to him.
Full 8 seconds wants to know if this would work on Forex, these techniques.
Wrong question. We already discussed. This works on anything that has fear and greed in it. Doesn't matter whether it's stocks, bonds, currencies, commodities, tulip bulbs. Anything that has fear and greed, candlestick analysis is the analysis or the graphics of investor sentiment, not any specific trading entity. So Forex works just as well, yes.
What about for long-term investments? Big wanted to know.
Same thing. It works. You can trade the E-minis on a 1 minute, 3 minute, 10-minute combination, which I used to do. Or you can trade long-term on a daily, weekly, monthly evaluation. Candlestick signals are the graphic depiction of everybody buying and selling during a specific time frame. You can just move that time frame to whatever time frame you're trading.
Big, Chorney and Mike say both have good things to say about the T-line. Mike says, I love the T-line. And one other, I think, really important question for you, Steve. What plans do you have for this weekend?
Nothing on this weekend.
Next weekend you're teaching the class. Right?
Yeah. So this weekend I'll probably be updating a lot of charts. We go through probably 400 or 500 charts on a 2 days of 8 hours of sitting. I tell people you're going to sit for 8 hours. I tell people you don't even have to get out of your pajamas. Just bring your cup of coffee in your pajamas. And like Groucho Marx said, one morning I got up and I shot an elephant before breakfast in my pajamas. How he got into my pajamas, I'll never know. So you get a lot of information, and what is the most compelling thing, and the reason we put this type of training together is if you see everything in a chronological, logical order, you just start seeing the sense that it makes that the price movements are based upon what human nature does, not what the fundamentals are.
Okay. I also want to point out that we're going to be doing a formal class with Steve Thursday. It's Thursday at 6 Eastern. Am I remembering that right?
I think so, yep.
Mr. Kelly Clement is going to put the link right here in your chat window in just a second. I want to say thank you, Steve, not only for coming in here today, that was a really good session, but for all the work you've done with us for the last, decade and a half or so. It's been great. I want to say thanks for everybody that's been in the YouTube room that came in and talked. We had a great session today. I enjoyed it. And I think that's what we've got for you.
All right.
Thank you again, Steve. I appreciate your time and coming in with us.
Can I tell them why they shouldn't over-evaluate candlestick analysis?
Yeah, I'd love to listen to this. Go ahead.
It's like the lady that brings her parakeet into the vet and lays it down on the table. And so I always use this illustration to tell people you don't have to over-evaluate candlestick signals. She laid the parakeet down on the table and said, "Can you help my parakeet? He's been my best friend for years. Isn't there something?" He goes, "Ma'am, I think your parakeet's dead." She goes, "Oh, isn't there something to make sure he's been my best friend?" And he goes, "All right." So he goes out to the back of his clinic and brings a cat in. Cat sniffs the parakeet on the table, shakes his head, looks up at the vet, vet says, "Ma'am, I'm sorry, but your parakeet's dead." She goes, "Oh, you sure? Isn't there something? He's been such a good friend of mine. I'd hate to lose him." He goes, "All right." So he goes out to the back of his clinic and brings in a great big Labrador retriever. Comes bounding in, puts his paws up on the table, sniffs the bird, looks up at the vet and says, "Ma'am, I'm pretty sure your parakeet's dead. I'm sorry." So they go out to the front desk, and he says, "All right, well, that'll be $250. She goes, "You're charging me $250 to tell me my parakeet is dead?" He goes, "No, ma'am, I would have done that for $18. Then he wanted a CAT scan and a lab report after that. So I tell people, you don't have to overanalyze on candlestick analysis. It's just common sense put into a graphic depiction. So I'll leave it at that.
All right. Thank you, Steve. I love that joke. I absolutely love it. On Thursday, we'll have to do the one about the weather forecasting.
Okay. All right.
All right. Have a good weekend, Steve.
All right.
Enjoy it. And thank you for everybody for coming. We'll see you at the next one.
All right. Thank you for having me.
Of course.